Hello, welcome to America First Wealth Management and Investment Outlook for January 27th, 2025. My name is Dan Lew. I'm the Chief Investment Officer and Portfolio Manager at America First. Turning to our standard disclaimer, this material is intended for information purposes only, and we're not offering to sell anything or render any investment advice. This is strictly our opinions as of January 27th and are subject to change without notice. Turning to our market outlook, let's focus on our President Trump watch. Since inauguration, Trump has signed 30 executive orders and revoked 78 of Biden's executive orders. And just to put some context around it, Trump signed 220 executive orders in his first term. Biden issued 162 executive orders. Biden revoked about 33% of Trump's first-term orders, and Trump has already revoked a little over 48% of Biden's executive orders. In terms of the executive actions that we feel have the most consequential economic impact, we have summarized them below. First is the imposition of 25% tariffs on Canada and Mexico, effective February 1. It remains to be seen if those are actually going to go into effect, or if Trump is trying to work out some sort of deal. He's announced a withdrawal of the U.S. from the OECD global tax deal, which was imposing minimum corporate tax rates of 15%. And by the U.S. Leaving that, that could open up the U.S. Corporations overseas to be subject to tax rates that are not set at that minimum. So that could have some implications on multinational U.S. companies. Trump has also declared a national energy emergency, which is going to make it easier for energy companies to increase drilling activity. Trump has stated that he believes that if the U.S. were to increase their energy production, that would lower oil and gas prices, which would consequently reduce inflation rate and also lower interest rates. So that's his plan and rationale for declaring the energy emergency. He also revoked the green clean energy initiatives that the Biden administration had, so that obviously has an impact across that area. It also will reduce some of the costs that companies were spending on clean energy initiatives, which is obviously a benefit to companies that were previously paying something for it. Long-term effect on the environment, however, remains to be seen. Trump also repealed Biden's AI risk mitigation policies, which had created some additional burdens for companies in the AI space, needing approvals at various agency levels of the government. So getting rid of those makes it easier for companies to be competitive in the AI space without having to be subject to additional government oversight in the arena. The other thing that happened over the weekend, which was interesting, Trump had begun deporting migrants, particularly ones that had a history of criminal record, back to other countries. Colombia initially rejected 2 plane loads of migrants from the U.S., but Trump immediately threatened emergency tariffs on Colombia, and Colombia backed off. The good news is that coffee prices will not spike up as a result, and it shows that Trump is serious about enacting his policy of deporting migrants, especially those who have committed crimes before. The big news that everyone is concerned and watching today is that last week it was announced that a Chinese AI model called DeepSeek was able to produce and do machine learning and produce an AI model that was demonstrably as good as OpenAI's ChatGPT. And it did so using less expensive, older GPU chip hardware, and did so in a much faster development time using open source code. This created a lot of discussion among the AI community, and eventually when it hit the financial community, investors and the financial community was very concerned that this would completely disrupt the market. The established large companies that had dominance in the area would be under threat as more cost efficiency would result in less profitability and disruption in the current current pecking order of who's going to be winning the game. Ultimately, competition is good, but market disruption is a concern. And given the high valuations in the markets, and especially these AI and AI-related stocks, this resulted in a large sell-off today on Monday. And it's having an impact. We do know that uh, competitors like Meta and Amazon and others, they're reevaluating their AI strategies. They're going to try to incorporate the similar efficiencies that DeepSeek has, and it's going to drive a shift in the way companies get involved in the AI space. So the uncertainty is certainly creating volatility in the market. It's probably more of an excuse to sell, as we had highlighted in the last several weeks. Market valuations were clearly extended. There was a lack of breadth, concentration in a select group of names. So we deem this to be more of a healthy pullback to more of a mean variance pullback and a rotation to other industries. And ultimately, we believe that DeepSeek is going to elevate open source AI models to be more competitive, robust, and more cost effective. It's certainly a disruptive moment, but an evolutionary one. There are also proprietary and specialized AI models that have been developed for specific areas like drug discovery. And those we feel will still be in high demand as customers of these models are more concerned about performance and support versus low costs. As we know, using open source models requires a higher level of expertise to deploy and modify, enhance, and support those. And while there are companies that can do it, most AI users don't have that specialty, that in-house specialty or expertise, and they would prefer to have the support of experts to provide that via proprietary models. We also think that we'll probably evolve towards a hybrid approach using both proprietary and specialized models. The other thing that's going to happen with the new techniques and lower costs, you have this democratization of AI, and more entrants will enter the industry due to the lower barriers of cost, and that is certainly one of the positives that open source code enables. It's kind of group and community work, and the collective evolution will be supported by many people who support open source code. Now, here's a quote from a NVIDIA spokesperson today that said, "DeepSeek is an excellent AI advancement of a perfect example of test time scaling." Test time scaling is a machine learning technique that allows the inference generation while the model is being built and tested to be modified in real time. Therefore, essentially means that as you're testing the model self-corrects and improves. So that's time test scaling. And I think that's an interesting technique because it allows AI models to scale. And as NVIDIA points out, there's 3 scaling laws: pre-training, post-training, and this new one, test time scaling. So this is more of a evolutionary step in the AI industry. We don't think this is the end of it, although it certainly looks like the drop in the stocks will trigger some panic, obviously. But we think the industry will certainly recover and be more ubiquitous across pretty much all of the industries and possibly even humanity. Turning to key macroeconomic events, today on Monday, we had new home sales. Consensus was 670,000, and we actually beat that with 698,000. So that was a positive in real estate. And certainly today, the 10-year bond rate dropped quite a bit due to the sell-off in the markets. So that hopefully will spur a drop in mortgage rates and spur additional home construction and home sales. On Tuesday, we have consumer confidence, 10 a.m. Wednesday will be the big day in terms for the market. That will be the Federal Reserve policy decision at 2 p.m. The Fed is expected to maintain its current interest rate at 4.25% to 4.5%. Certainly a surprise would be if the Fed were to reduce their rates once again. That would certainly spark the market to recover. However, if the Fed noted that they saw additional inflation and were cautious and waiting to see additional data before they further reduce rates, that may spur the market to sell off further. Turning to Thursday, we've got the fourth quarter GDP advanced estimate looking for 2.6% annualized growth. 10 o'clock on Thursday, we've got pending home sales. And Friday, we've got an important number, the PCE index, which we all know is one of it's the Fed's favorite inflation number that they look at. We're looking for headline PCE of 2.5% year over year, and excluding food and energy up 2.8% year over year. As we know, the Fed's target is 2%, but certainly if we are in that neighborhood or declining further, that would be definitely a positive for the future direction of interest rates. And also later that day on Friday, we've got the Chicago PMI number for January. Consensus estimate is 39.6. This is also a very big week for earnings. We're just highlighting the key S&P 500 company earnings, and later on we will show all of the S&P 500 companies that are reporting this week. But beginning the key company earnings on Tuesday, we've got GM, Lockheed Martin, and Starbucks. I won't read the estimates and revenue estimates. Viewers can see it for themselves. Wednesday will probably be the most important day in terms of earnings. In addition to the Fed rate decision, we've got Microsoft, Meta, and Tesla. And Thursday, we've got Apple and Visa. Friday, Chevron and ExxonMobil. So those are the key S&P 500 company earnings for the week. Turning to the weekly market stats for last week, which is what we normally cover, was overall a strong week for the markets. You can see all the equity indices were up nicely, led by technology names in the NASDAQ and NASDAQ 100. Growth stocks, Russell 1000 growth was also strong. In addition, the Dow was up 2% as well, 2.15 actually. International stocks were strong, 3.19%. Bonds were essentially flat. The iShares Core US Bond ETF is only up 9 basis points. And then the year-to-date numbers, moving over a few columns, we can see a pretty strong start thus far, although most of these gains are going to be reversed with today's drop in the markets. But we can see clearly it's been a good start for equities for most of January. Turning to the Magnificent Seven, which we have continued to follow, we can see that 5 of the 7 names were up. Only Apple and Tesla were down for the week. And year to date, 6 of the 7 are up strongly. Apple is the only one that's lagging, down 11%. And the Magnificent Seven names have continued to be a good place to be by and large, relative to the indices which are shown below. Turning to sector performance, here we are starting to see more divergence. As we had pointed out, we're likely to see more broadening out, and it's good to see that. For the week, we saw communication services, healthcare, industrials up near the top. Technology came in 4th for the week. And if we flip over to the year to date, we can see that industrials are leading, up 7.1%. And financials are up there as well as materials are up there, and energy up 6.6. Even though energy was down for the week, it's one of the stronger performers of year to date. So I'll leave this up here for a moment so our viewers can look at it. But it's nice to see all the indices clearly trending up and being a little divergent versus the previous 2 years' results, where we can see in 2024, 2023, we've had leadership largely driven by different sectors than we're seeing now. So we're seeing a broadening out, which is quite positive. The S&P 500 up until Friday clearly had been moving up above the 10-day moving average. And the RSI was getting a little bit towards the oversold. Obviously, today we're going to see a drop due to the market sell-off. But we don't see an end to this run in the market yet. We believe the market's going to digest the AI DeepSeek shock, so to speak, and recover nicely. 10-year Treasury yields ended the week at 463 versus 461 for the prior week. Sorry, that's not January 17th, 24. It's also 2025. So we were just up 2 basis points on the week and just up 5 basis points of year to date. Looking at the trend, though, the rates have fallen from their peak this year, and certainly after today, rates will be down even further. Turning to yield curve, not much to say here in terms of dramatic shift from week to week, just slightly higher since the beginning of the year. Again, we have got a positively sloped yield curve, which does bode well for our opinion for normal operations of financial companies, where they tend to borrow short and lend longer. So having a positively sloped yield curve is beneficial to net interest margins and financial company profitability. And then the economic calendar, we highlighted the key economic numbers for the week. This gives all the detail, so I won't go through it in detail, but I'll just flip through it. It's Wednesday, Thursday, Friday. And then the S&P 500 earnings, it's quite a bit. This is Monday, Tuesday. You noted GM, Boeing. Um, Wednesday, Microsoft, Meta, Tesla, some big companies on Wednesday reporting. Unspecified, we do have Qualcomm up there, another important tech company. Thursday, quite a few. Definitely a very busy week in terms of earnings. After the close as well, we've got Apple after the close on Thursday. Baker Hughes, Intel, Visa, KLA, all important companies we're going to watch carefully. And closing out the week on Friday, Aon, Chevron, Eaton, ExxonMobil. So there you have it, a very important week, starting off with a sell-off due to the impact of DeepSeek on the AI industry. And the market certainly, to us, was looking for an excuse to sell off and correct. We don't feel that things are fundamentally changed in any way. The market is still looking towards the new administration's leadership and how they implement their policies. And certainly every presidential administration is tested by the markets or some sort of geopolitical event. And we'll certainly watch and see how the second Trump administration handles its challenges as we move forward. The good news is Trump is a businessman. He understands and pays attention and cares about the financial markets and interest rates because he does know that that impacts companies and Americans in terms of their ability um, to meet out their financial challenges and I think that's a net positive. But again, we begin the year with an overvalued market seeking a potential mean reversion event, which might have started today. We will see if it continues or we end up in a better place by the end of the week. But this is clearly an important week, and we'll be watching carefully. Thanks for tuning in, everyone. If anyone would like additional information or set up meetings with us, please feel free to contact myself or Jim. Our emails are posted here. And thanks for tuning in today. Have a great week and hope we end up better at the end of the week than we began it. So, thank you. My name is Dan Lew, Chief Investment Officer and Portfolio Manager at AmericaFirst. Have a great week. Thank you.